The market just did a loud, embarrassing sound. Let's not panic, at least for the first 30 seconds. This is not financial advice, it's a friendly slap of common sense. About 150 billion vanished in an hour. Why? 3 usual suspects. First, a flare-up in the US-China trade drama. Second, renewed chatter about a US government shutdown. Third, taxes. People cashing out to make accountants less grumpy. We saw a similar mess in April. The best money was made by people who didn't freak out. Fear is not a strategy. Here's why the long game still looks bullish. Crypto ETFs keep growing. Wall Street is tokenizing because it beats ancient ledgers, held together by coffee and spreadsheets. Corporations are quietly parking digital assets in treasury. Governments keep printing and spending, which makes hard cap assets look pretty cute. And a downshifting interest rate cycle is oxygen for risk assets. Short version, today looks broken. The story doesn't. Yes, price can still take another step down. Maybe low 100s for Bitcoin, maybe high 90s, depending on your chart religion. 6 to 18 months out, odds are the chart cites higher than today. This cycle's been modest. That's good. Less foam, more fundamentals, less hopium, more flows. Institutions? They're here. They hold a serious chunk of ether, bigger than ever. Major brokers talk about tokenization as when, not if, and meme coins oddly prove the plumbing. If a dog coin moves billions at 2 in the morning and nothing breaks, the rails work. Even the most stubborn Bitcoin maximalists admit Ether has earned some respect from the old guard. The bridge between Wall Street and crypto is built with liquidity, not slogans. Flows are shifting. ETF inflows climb. Advisor access widens. Some money leaks from legacy index giants and hunts for new themes. Bitcoin and Ether are on the short list. This is a global trend, not a local squiggle. So what now? Newcomers make one classic mistake. They sprint to cash at the lows. Please don't. Make a plan before emotions rent the place. Think in horizons of 6 to 18 months. Use dollar cost averaging instead of trying to high-five the exact bottom. If you use leverage, use stops like a responsible adult who enjoys sleeping. Remember your why. Crypto is an asymmetry story. Limited supply meets expanding demand rails. That's the entire pitch in one sentence. Sell-offs are called sales for a reason. They're not invitations to scream. They're invitations to check your plan. Here's a simple checklist. 1. Decide your core allocation to BTC and ETH, then stop changing your mind every time Twitter gets loud. 2. Set a DCA schedule you could explain to a 5-year-old. 3. Define invalidation levels before you buy, not after you cry. 4. Keep a small curiosity budget for experiments because saying, "I told you so" to yourself is priceless. 5. Measure in quarters, not hours. Hours are for drama. Quarters are for outcomes. Volatility is the fee you pay for future upside. If you hate the fee, buy a bond and a blanket. If you accept the fee, bring patience and a plan. A quick word on expectations. Rallies will be rude, dips will be ruder, headlines will oversimplify both. That's fine. Markets are messy on the surface and surprisingly rational underneath. Liquidity, rates, and adoption still drive the bus. Right now, the driver may be sneezing, but the bus is still headed forward. If you feel overwhelmed, zoom out. Ask 3 questions. Is the network stronger than last year? Are on-ramps and products easier than last year? Are large players more involved than last year? If the answer is yes, you're probably early enough. The market might sneeze again. Keep tissues and a strategy. Stick to your horizon, protect your downside, and let compounding do the awkward silent work while everyone else argues online. That's it. Breathe, plan, execute, then go touch grass so you don't touch your stop loss.